Options model portfolios really form the bedrock of our strategy here. And they are by far our most popular product because of their set it and forget it nature. So really what we like to deliver with the options model portfolio is one of the easiest and most accessible ways for you to access options strategies. So the options model portfolio, we have 3 different flavors here overall that we're going to get into a lot of detail with. But the idea behind the model portfolio is to give exposure across a variety of different market environments with the simplest structure possible. So I'm going to go ahead and pull up our presentation right here to start talking a little bit more about these model portfolios that we've got here at Harvested. So one of the key components of a model portfolio is the idea of systematic exposure. And so we talk a lot about systems here at Harvested and how maintaining systematic exposure and executing strategies in a systematic manner is one of the best ways to get exposure to the options market. That it's not about necessarily a single trade that's going to provide the winner. It's not necessarily about even a set of trades, but it's about repeating that strategy over time across different market environments that allows you to capture that opportunity. And so systematic exposure to the options market environment is what we provide here with our model portfolios. There are 2 major investment themes that underlie these model portfolios. The first is the idea of the equity risk premium. And so the idea that over time, equities tend to earn a risk-adjusted return that is greater than what is provided by the risk-free rate. And we've seen that over 150 years of data in the equity markets. There are ups and there are downs. We saw downs in March. We've seen downs many times before, but persistently over time, equities tend to outperform. And that's a bias that's included in our model portfolios. The other major facet and theme that the model portfolios are looking to access is the volatility risk premium. And so that's sort of a feature that's pretty unique to the options market. And the volatility risk premium, I like to think of as sort of a way to remunerate the providers of insurance and the providers of capital and liquidity in the market. To the extent that you're willing to write insurance by selling options, you are providing that insurance to the marketplace, and that delivers a remuneration over time. That consistently the implied volatility of options exceeds the realized volatility. So over time, now, like we mentioned, that it's not necessarily on any given trade, there are winners and there are losers, but over time, the persistence of this volatility risk premium is very much a feature of the options market. And like I said, it's remuneration for providing that insurance. So that's also a facet that we want to stay exposed to here with our model portfolios. So those 2 structures very much inform the design here and the overarching sort of investment thesis behind what we're looking for. Model portfolios are also about the diversification alternatives. So it's meant to be a sleeve of different in your portfolio. This is not necessarily meant to be an entire allocation. We typically think of targeting somewhere in the 5 to 20% range, looking at your overall picture. It's not meant to replace an equity allocation or a real estate or a bond allocation, but it's meant to be a diversification alternative that both the return structures and the market environments that the model portfolios are targeting are designed to look different than the other types of investments that you might be familiar with. So really the model portfolio is meant to fit into a sleeve in your overall allocation and provide returns that are orthogonal, different, and varied from the rest of your investments. And we're going to talk about the 3 different themes here in just a little bit that we highlight with each of our different model portfolios. The main structure that sort of underlies our model portfolios has to do with a defined risk strategy that's pretty common in the options markets. The butterfly is a well-known options strategy that is meant to capture a little bit of a volatility premium, but target specific strikes and target the lack of movement, or inversely, a lot of movement in the market. But what we do here at Harvested to design our model portfolios is we modify the fly. So that's where the pun modify comes from. Haha, I'm sorry, everyone. But we set up the modify structure because that allows us to target more specific regions that complement the sort of returns that clients are looking for out of a model portfolio. So by adjusting the traditional butterfly structure and pivoting our risk return ratios across different strikes and centering our profit zone in different regions, we're able to create a structure that benefits both from that volatility risk premium, but also leans distinctly bullish in our amplify, more neutral in our diversify, or maybe even with a bearish tilt in the protect model. So fundamentally, it's about taking this very traditional options strategy and modifying it so that we have the risk and reward features that we're looking for in our model portfolios. And Ian and I are going to get into that, and we're going to get into some of the details about how we think about the different ratios between the modify, how we think about targeting our max profit zone with the modify, and overall how this portfolio structure can evolve over time to create repeated opportunities in the marketplace. So the modify can take three different flavors. And Ian, maybe I'll start to hand it over to you here a little bit. And you can talk about how we think about what the diversify version of our model portfolio does, how we think about what the amplify version does, and how we think about what the protect structure does.
All right. Thank you very much, Mark, for the introduction and the overview to how the model portfolios can fit into everyone's overall financial portfolio. And like Mark was explaining, when we look at our modify structure, we're going to get into some more technical aspects shortly. But when we look at kind of these graphs, they definitely look different than our traditional kind of upside down V butterflies. And we do it to target specific regions. So we have our diversify, amplify, and protect. And when we look at these graphs, we see the red line is 0, and which would be our profit or loss line right there. Anything below would be a loss, anything above is a gain. And when we look at our diversify, it kind of looks like a call spread to start, but we have this nice zone in the middle, which we're going to discuss a little later, kind of our max, thank you, Mark, our max profit zone. And you can see for the amplify, things are amplified, right? It's meant to be more bullish, has more of a focus and concentration of being bullish, but still has that max profit zone. And then for the protect, it's right in between a amplify and diversify, but it is different that it has a neutral to bearish focus, right? So as you can see now, we're flipped that as the stock actually goes up, we would actually eventually lose money, but you have a lot of room also in this max profit zone as the stock starts to trend down. And then as it goes lower, you start to make money and then eventually get capped out, which these three graphs, all have a lot of similarities, but by changing the structure, even just slightly, we can target specific, focuses and concentrations of reward to risk ratios that we want to look at. And it's really important to note define risk. Just like Mark was saying before about kind of we look at things at Harvested from a systematic perspective. We'll even get into rolling after discussing how that kind of all meshes with being a system. And part of our system is defined risk. And you can see here that from all these graphs, there's defined gains and there's defined risk. So there's no kind of, we just made super extra more or lost, there's a margin call. No, we go into it knowing risk and reward.
And I think that's really important. It's a really core tenet to the way we set this up and the way we think about risk budgets, that we take a portfolio approach here to options. And that's obviously implied by the name model portfolios, but I think that's important to know that these aren't necessarily lottery ticket type bets, and they're not necessarily meant to be hitting home runs. That our goal with these model portfolios is to get as many men on base as possible, to extend that baseball analogy, and hit a lot of singles while giving ourselves that sort of home run opportunity to the extent that might happen with the sort of max profit zone. So it's much more about hitting those singles and consistently targeting that sort of yield function that you're looking for, that we see in the diversify, that we see to a greater degree in the amplify, all while sort of, adjusting your max profit zone to align with, the way you want to complement the rest of your portfolio.
All right, excellent.
So,
All right, so what does the modify do? So we're going to use the term modify. Right? Modify is kind of our strategy within the model portfolios. So we're going to use the terminology a lot. So let's take a look at our graph. What do? We have the center strike, which is our short strike. So with all three of these strategies, whether it's diversify, amplify, or protect, we're going to be looking at the center strike as the short strike. We will be selling 2 of the short strike, and then you have your wings, and where we're going to buy 1 strike each. So this also refers to the concept of brokenness. And again, the traditional butterfly is just kind of upside down V. The lines go out parallel along the horizon. Everything's kind of equal. Here, we again look based on different ways of analyzing, the market and prices and reward to risk. We're going to break the fly and modify it. And again, so we'll see more examples after. Exactly the difference in strikes is not equal. So we'll see that closer up soon. Okay, so this is just a nice quick line graph of what profit, loss, risk, reward to risk would look like in an amplify strategy, the 361, 66, 68 put fly at 1 1/4, which means we sold this put fly, right? When we enter into these strategies, we are net sellers of the strategy, and we would be receiving credit. Now, these are all based on what we call a 1 lot, which means it's 1 option trade. You can do 5 lots, 10 lots, 100 lots, or 1,000, but everything kind of comes down to the same concept of a 1 lot. So looking at this 1 lot, we sell it at 1 1/4, and because options are based on 100 shares of stock in the United States, we multiply 1 1/4 by 100. So $1.25 equals $125. So with the stock at 364, and again, these are all based on expiration graphs, which we're going to see again, I keep saying in a little bit, we're going to see expiration graphs plus intra expiration graphs. But right now, the concept of an expiration graph is, okay, at 364 on expiration day, what would my profit and or loss look like at specific stock prices? So here at 364, we would make $125. 366 would be our max point, and make $325. And then eventually you get up to 366 and the stock keeps running, even up to 388 or 398, you would still make your $125. That's why the greater sign is there. We go back down to the negative side, the stock starts going down again, amplify, bullish strategy. We start to go down. At some point you expect, right, you have to have manager expectations. But potentially we'll start looking to lose, and we'll talk about rebalancing also later. The break even at 362.75. And then anything below 361, here's our defined risk. We lose $175. Whether the stock's at 361 or 341, right? It does not matter. That max loss is capped. So there's our defined risk.
Yeah, and just to pick up on that 1 lot idea, our model portfolios are really designed to be available at the minimum level possible. And so that's why we choose a lot of the strategies that we do, because we want that 1 lot to be able to get the most power possible. And so that's why looking at some of the most liquid ETFs out there on the market gives us that granularity to make sure that we can choose a 1 lot contract that has the defined risk reward structures that we're looking for. And that 1 lot increment, according to the risk budget, can come in slices as low as $1,000. So that means that model portfolios can start at only $1,000, but it also means that for every increment of $1,000, you get that increased granularity with your portfolio allocation. So the idea of breaking everything down to a single 1 lot and what that risk budget would be on that contract allows us to deliver these solutions for relatively small portfolios, but also really scale that up, as the account tends to grow over time.
Great. So we'll now look at a little more technical, right? We talk about brokenness, and now we really get to see, okay, there's 3 strikes, there's 4 options. The center strike is the important part to start, where we're centering where the modify will start. And again, traditional butterfly, you kind of go straight to what they consider the at the money. With the modify, we're looking to, in the case of an amplify, to push the center of that strike. And there's other factors in play, including the volatilities of the option prices. But just to kind of, for general purposes, we're going to set the center strike, and then we have what we call the upside and downside strikes, as the arrows indicate, and that will give us our modify structure and give us our credit that we receive to open a trade, and give us our upside yield capture, this $125. Again, this is for a one lot. Our downside max risk 175. Our profit zone over here, which would actually be between the stock price at 364 and 368, and our super max gain, which would happen at stock price at 366, the true center of our modify. So, and again, this is how we would adjust all of our different strategies each week.
Right. So this is sort of how we initially initiate a trade structure. So when we're looking out and we're saying, okay, now we've decided that we've closed our old position. Now, how are we looking forward and thinking about where do we want to position ourselves? We want to look at the options across several different months. We want to compare how the 1 month, 2 month, and 3 month options might look. But then we also want to compare within that term structure how those options might look. Where we want to target our max profit zone, and kind of how wide we want to target those different legs, all has a lot of really important impacts on that risk reward ratio.
Excellent. And that leads us to execution. And there's a lot in execution. I'm actually going to bring up TradeHawk, which is the option pricing platform. Actually, I'll bring up TradeHawk in a second, since that will stop this other one. So we're going to use TradeHawk, which is an options pricing platform through Tradier, where we execute our trades through and our model portfolio strategies. And using TradeHawk will be useful in showing kind of live views. Even though the market's closed, we get an idea of what we look at when we look at upside capture versus downside risk, expiration date, like Mark was just referring to, liquidity, risk and gains, and volatility. So I'm going to go and share this for a second, and I'm going to go to TradeHawk. Okay, everyone should be seeing TradeHawk now. All right, so in TradeHawk, I'll get my handy annotator out here. Okay, so it looks a little crazy at first if you've never looked at an option pricing platform. A lot of numbers, but that's okay. On the left side over here, we have SPY markets, and our model portfolios focus for the most part on the major ETFs, S&P 500, which is the SPY, QQQ represents the NASDAQ 100, IWM, Russell 2000. All these strategies can definitely work for other ETFs and larger market cap names that are liquid. But, SPY is the benchmark. So that a lot of people have their portfolios set to. And so that's one of our primary vehicles for setting the model portfolios. So we're going to look at SPY as our example here. So we see.
And I think it's actually, sorry to interrupt real quickly, but it's both because it's such an interesting benchmark, and maybe these are one and the same things, but because it's so actively traded, it makes for great execution quality. It means, so I talked a little bit about how it gives us that granularity of strike selection. It gives us the, number of different expirations that we can choose over time. But it also means that when we go to execute trades, the pricing is incredibly liquid. So that we're seeing options markets that are a penny and 2 pennies wide for the most part. It means that when we go into the spread books, where we might start seeing, multi-legged trades that are nickel and dime wides, there are plenty of liquidity providers, and there are plenty of participants in there that are willing to provide price improvement. And liquidity begets liquidity. So that really benefits the ultimate execution price that we're going to get on the intake of our trade and on the outset of the trade, because both matter a lot. Every single penny in an options contract means $1, and those really add up over time. So the marginal execution savings that you can get from trading in these really efficient markets really compounds itself over time.
Yeah, it's an amazing point. And like Mark said earlier, like our systematic approach to the model portfolio strategies is about hitting singles, giving yourself an opportunity to have that double or triple or occasional home run. But if you're in the game, right, and you keep getting singles and walks, those pennies add up. And just on one lot, right? And if you end up doing 4 lots or 10 lots, they just multiply. So SPY is a great benchmark, like Mark said. And so over here, we see our trade. Again, these were markets from the close today. They would be live during the day. So green means we buy, red means we sold it, green means we bought. So this is our structure over here. Sorry, so we bought 1 370 put, sold 2 368 strike puts, and we bought 1 364 put. Up here, again, as Mark referenced to, there's a lot of different expiration dates in SPY, which again makes it another great example of granularity for durations that you can choose. So we're sticking to December 18th right now, which says 17 days to expiration. Of course, there's a lot more expirations as you go out past December 18th too. So we have our scenario analysis over here, and we're going to look at our scenario.
And while you pull that up really quickly, and one comment on why the December 18th we might be looking at. So December 18th is what we refer to as a serial month. And so back in the olden days when options were only listed every month, that they would have the November options and the December options and the January options. And those traditionally expired on the 3rd Saturday of the month. They closed trading on Friday, but all the back office work took an extra day. So they actually didn't expire until that Saturday. We've moved that expiration to Friday, and we've added a bunch of weeklies thanks to all this technological progress. But the serial expirations still persist as one of the most liquid expirations to trade in. So it's actually only the top 350, 400 names that end up having the weekly expirations over time. So it's not necessarily all stocks that have the weekly expirations. And quickly down the curve of liquidity, the kind of potential for price improvement and liquidity that you can get in those weekly expirations really falls off quickly. So even if you're looking at a top tier name like SPY, the liquidity in those weekly expirations really matters. As an interesting anecdote, we were actually trying to trade on Friday after Thanksgiving for the Thursday before Christmas Eve, and it couldn't possibly have been a more illiquid set of markets to look at. And we didn't end up trading on those days because of the pricing there. And instead of selecting the December 24th strike, expiration, you end up selecting the December 18th, just because it's going to be expensive to get in and it's going to be expensive to get out. So knowing where all that open interest is, where that activity is, really helps inform sort of the expirations and the tenor of strategies that we're choosing.
It's all excellent points, and what we strive to do here at Harvested for our clients. Because again, we're hitting singles, and then every time you can work to save pennies for execution, entering the trade, rebalancing and exiting, and giving yourself more opportunities to get the doubles and triples, it really multiplies to what is possible for your performance relative to your risk, especially. So we have over here our scenario, and this is our graphs like we looked at before, and what we see here from this modify, the December 18th expiring 364, 368, 370. Here's our center strike, 368. Our long upside is the 370. Our short's the 364. And now the green is actually what we call our expiration graph, where we would net make $76 for upside versus losing $124 for our downside risk. So it's the first kind of thing that we can do is look at, okay, what would kind of be our upside capture yield versus the downside loss? So that really helps us structure, what that ratio is and what we think it should be. And this is somewhat dependent upon the volatility of the option prices, which is a little more in depth to get into now. But that's something that we look at. And also because we have the ability to look at Qs and IWM and other securities, that might enter into the picture for the model portfolio selection. Other things we looked at, like Mark just talked about, granularity and duration, expiration date, right? We could look at multiple weeks versus multiple serial months of expirations. And I always love it when Mark brings up olden stuff, because he talks about it and I remember it like it was yesterday, because I was in it. I was in on Saturday mornings with pen and paper, checking expiration stuff for our serial month. Well, at the time, there were no other expirations, right? They were the expirations, and you would be in at 7 a.m. with pencil and paper, making sure that everything cleared correctly. So I always like it when Mark brings up stuff like that. Shows my
The
age.
best part of Expiration Saturday was the free breakfast that you got.
It's unbelievable. It really wasn't that long ago, but it was unbelievable what we did with these giant books. And I thankfully it was only one expiration per month, because I don't think we could do that 3 times a week. So much better now. Tight markets, great liquidity. Different ways to choose different expiration dates for our entry, and then the rolling liquidity we spoke about. And then we put it all together and we end up with a modified structure, whether we consider it more diversify or amplify, because it's either more neutral to bullish or amplified bullish, or it's kind of a protect situation where we want to have the neutral to bearish focus. So this would be, again, this green is our expiration graph. Kind of the next level of webinars would be discussing kind of between today and 18 days from now, which is expiration. These lines over here reflect how we expect the strategy to perform, both reward and risk, as the stocks move, the ETF or stock moves according to the graph over here. So as I click on these different days, that's theoretically how our P&L, profitability and or loss, would kind of showcase itself throughout expiration, all the way to expiration. All right, so we'll get back.
Let's talk maybe about some of the risk rewards and some of that scenario analysis in terms of how this evolves.
Okay.
If you undo your screen share, I'll be able to grab it back from you.
There you go.
So some of the different scenarios, we talked about how we set this trade out initially, looking at a tenor of 1, 2, or 3 months, depending on sort of the volatility term structure. But as the trade evolves, we don't set a trade and forget it. We have a lot of evaluation that we do over time to look at how, the path dependency has changed, right? That, while these strategies are generally bullish and while they do benefit from volatility, premium capture, and earning all that return, where the stock actually moves on any given day is going to have very real P&L implications. So over time, if the stock moves in our direction favorably early on in the trade, that might be an opportunity to initially to close it out early and reset the trade. Alternatively, if the stock moves against us, very early on in the trade, that tends to be correlated with high volatility environments. And so that also provides an interesting opportunity to reset the trade at a higher volatility. So we're talking about risk here. I know Ian's going to get into this a little bit more, but really the main risk of this type of strategy is going to be a slow leak down over time, that the market really dripping down persistently without a lot of exit opportunities is going to be sort of the worst case scenario in this. That a sharp elevator down, like we've seen quite a bit in the markets, over time, but that actually is also highly correlated with elevated volatility environments and increased opportunities to unload options that you might be long at a premium, and also enter into new trades at a higher volatility ratio that does have that altered risk or improved risk reward structure from selling that elevated volatility. So I think, in terms of the risk, it's really this slow and steady decline that, presents the greatest risk over time. But slow and steady also benefits if the stock just sits there. So slow and steady down might be a bad risk, but slow and steady sitting there really is also equated with deflating of that insurance premium and that volatility that you've sold in the diversify and amplify strategies. So, collecting that theta and letting the sort of clock pass, that is a real benefit from in the strategy.
That's a really good point about the theta, Mark.
Definitely. So the flip side of this is the reward that we're going to talk about. So that comes in both, or actually in all three flavors, in terms of that directional bias. So both the diversify and amplify have their yield premium that they earn to the upside, and a yield that comes from a rising market, a deflating risk premium in the option structure, and generally time passing. They both see that max gain in the protect on the downside, where stock happens to pin exactly in that place. So we like to sort of push the max gain out of our minds and treat that as like the nice home run scenario, that if that happens, that hole in one, needle in the haystack scenario. But it's a really nice sweet spot to hit if the market settles where you're looking for, and it does provide some nice upside returns on the structure overall. So getting into some of these real trading aspects, I mentioned time decay, and that's actually a really big part of this whole strategy, that by being short options, you are collecting theta, or you're collecting premium over time. Every day that passes, assuming nothing else happens, that option is going to be worth less and less, and the item that you sold is going to be worth less and less, earning you returns. So generally, when providing insurance, when providing that capital, when providing that supply and liquidity to the marketplace, you're benefiting from lack of movement and lack of a scenario happening. An interesting feature of this time decay, though, is sort of how that nonlinearity happens. So, do you want to talk about how sort of that theta cliff that we see coming into expiration?
Oh yes, the theta cliff, definitely. So we looked at the graph of the trade hawk just before, and can I take the screen back for 1 minute?
You can.
Just go show that theta cliff. Okay, so we were discussing, we're right here, December 1st on this line, and then each day, if we stay roughly in the same place, we start to make some money based on what Mark was discussing and explaining about decay. And notice what happens right around December 11th, right? But up until then, it's kind of like small, like we just seem to keep making, which is decay coming out of the option positions, strategies working. And then you start to see more jumps and more jump, right? And then the final jump to expiration. But even before then, like the expiration week, that theta really starts to kick in. And, Mark mentioned the phrase nonlinear. So it's not that the options lose like a penny a day or 2 pennies a day. It may seem like that early on in the strategy, but as you get closer and closer to expiration, there's a real jump, almost geometric in progression of decay. So all of a sudden, you really can see that your strategy here, especially with this max profit zone, starts to kick in quickly.
So we actually have a good question from one of the audience members here, and that has to do with, would you have a long-term protect with multiple more aggressive short-term contracts? That's actually a brilliant question, because that's actually very much what our sort of comprehensive protect structure looks like. And actually, Ian, if you give me back the screen, I don't have this necessarily in the slide deck, but I will pull up our white papers. And so we do have white papers available on all of our different model portfolios. If you go to our website under the model portfolios page, under that route, you'll find a link to each of these white papers there that goes into a lot more detail and sort of is the one pager to take a look at this. So structured as a portfolio, we're looking to maintain that sort of overall exposure, and that's much more what this managed downside looks like. And so that's going to be that sort of bear yield that's positive that Ian was talking about, with that bull yield that's going to kind of be a negative number and cost you, because protection costs money in the options markets. But in terms of layering some of the strategies, that's what we look for in our comprehensive form of protection overall. And the fundamental truth about protection and getting insurance in the options market is that it costs money, and that you can't get nothing for free, or you can't get something for free, I should say, and that the way we sort of manage that overall cost is by targeting different sections of the curve and playing with different option tenors to provide coverage in those sort of places that we're most looking for it. If you were to take the simple example and just buy a put on holding that you had. So you owned 100 shares of Apple and you wanted to protect that. Buying a put is the most direct and explicit form of coverage there. That's going to be very expensive because it provides unlimited downside. So to the extent that your Apple shares went to zero, your put would protect you all of the way. It would protect you from exactly the price that you purchased it all the way down there. What we look for in the sort of comprehensive trade structure is managing this cost overall. By way of sort of comparison, if you're looking to protect an SPY portfolio for the course of the entire year, you're gonna, now it depends on the volatility environment overall. And now we're entering or starting to enter potentially a low volatility environment where these numbers might drift down a little bit, but you're talking almost double digits. You're talking 9, 10, 11% of your portfolio value to provide that protection. That's really expensive. And in many ways, that almost offsets any gains you could potentially expect from that over time. So often for long-term investors, the cost of that protection becomes too much. However, if you have an isolated scenario, perhaps you have equity that is particularly concentrated, whether it's inherited, whether it's company stock, variety of different reasons why you might be looking for a little bit more capital security in your position. The comprehensive protect structure provides that debit exposure, so you're going to be paying for this over time, but we do play around with managing that cost through really two different features here. So the one feature is going to be what we call the multiplier range. And the multiplier range is a targeted section of the curve that we say we're willing to give up a little bit of the first move in the stock. That maybe if the market goes down 5%, that's okay, and I'm willing to give up a little bit of that. So we can reduce our cost by giving up the first 5% and accepting perhaps that as natural volatility. But then by targeting a range, maybe from 5% to down 8, 10, 15%, we buy a section of the curve through a position that looks like a condor or a strangle, and we focus on that area. And we can usually access those for relatively cheap prices. And by loading up on those at a multiplier in proportion to your overall position, we get that sort of initial or that coverage across that range. But to the question about do we use shorter term options, the shorter term options are that downside convexity that we're looking for. Because while that multiplier range might help, for those medium drawdowns over the medium term, this does still remain exposed to that short, sharp drop. And the price of an option is directly correlated to how long you're going to hold that option. So shorter duration options are going to be significantly cheaper. So you can achieve that downside convexity at a reduced cost by rolling into some of these short-term options. Depending on the market movements over time, those may or may not be necessary over the sort of life cycle of that trade. But in general, this comprehensive protect strategy is about managing that cost of protection because, like I said at the beginning, to protect your money costs money, and that insurance doesn't come for free. So really in the protect structure overall, it is about managing costs and using shorter durations and playing across the options term structure is a great way to manage that cost overall.
That's an excellent question.
So I'll get back here to time decay, because we were talking about how that's one of the things that really benefits the structure over time is time decay. That fundamentally this is a net short option strategy, and so every passing day time decay works in your favor. So you want to talk about implied volatilities, Ian, and how maybe like that changes both trade initiation and trade P&L over time?
Sure. So implied volatility is kind of like implied volatility is really important to the value of an option price. Time decay is definitely a characteristic of all options and important, especially as you get closer to expiration. But implied volatility is the main element that gives an option its price, whether it's worth $2 or $4. So implied volatility is ultimately derived through market demand and supply forces. So let's say pre-election, just about 5 weeks ago, implied volatilities were much higher than they are now, especially over the last 2 weeks. Implied volatilities continue to drop. And what does that mean? So when implied volatilities go lower, it means option prices are cheaper. So when we think about our modifies, our center strike is the short strike and it's 2 options. So when we're selling options, it's nice to sell them at more expensive prices. If they're cheaper prices because implied volatilities are lower, that means we have to take a look at what is the price of the 2 options we're selling versus the wings, the upside and downside that we're buying to create the modify, right? Because you want reward for the risk that you're taking, right? Because you are selling these options, you do have risk as the market moves past a certain amount. So we want to look at that. And of course, we also want to look at our max profit zone, right? We don't want just a call spread or a put spread type scenario. We want that max profit zone area. So we really need to look at the implied volatilities of each strike and figure out what the best mix is to create the modify, whether it's diversify, amplify, or protect. And again, because we are short the center strikes, the higher the implied volatilities gives us in some ways more options, more, I guess, different opportunities to look at, but it doesn't mean that we won't have anything. It just means that when we look at implied volatilities, it's important because as it goes lower, we just have to adjust the way the strategies are constructed. Now, it's almost like looking at a balloon. When a balloon gets inflated, think of it, volatility is going up, and when the balloon deflates, volatility is coming in. It's kind of, I think, a nice visual for it.
Absolutely. And then I think the last element here, right, is the rolling aspect of it. And so I alluded to that a little bit earlier in terms of having a number of different outs with this strategy and being able to capture that opportunity as it evolves over time in the trade structure. So we don't necessarily always wait until expiration day to roll, to the extent that we're really zoning in on that max profit zone and waiting for that theta to really just leak out at the very end. That might require waiting up until 259 on expiration day. But to the extent that the market's moved in our favor over time, we look for opportunities to roll early. And so, it's dependent on the time decay. It's dependent on how far along in the overall strategy, how much the stock market has moved over time. That one of the greatest, impacts, we talked about volatility, we talked about time, but where the stock is priced actually has a very fundamental impact on the options price. So if we do see positive directional movement in the stock, that does present the opportunity to roll and initiate a new trade that has that continued positive expected value. And the more trades we can roll into over the course of the year, the greater the yield we are able to capture. If Michael Jordan wants to play you in a game of basketball, he wants you to play you as many times as possible. If you want to play Michael Jordan in a game of basketball, you're looking for that one fluke. We believe we have edge over time in the market, and so we're going to persistently try and get as many shots on the net as possible. I realize that was a mixed metaphor there, but fundamentally, it's about exposing yourself over time and maintaining that systematic exposure to a positive expected value trade.
Yeah, rolling is extremely important. All right, Mark is going to talk about rebalancing.
Yeah, so this gets into a little more detail about some of those rebalancing scenarios that we talked about. So the market rally is a great opportunity to take advantage of a rebalancing. Delta is very much our friend in this strategy. So early exit opportunities, sideways markets. To the extent that the market just sits there, that might actually be a scenario where we do let it carry on over time and deflate. So to the extent that we have a little bit of a sideways market over time, and then less of a delta matters later on in the strategy. So both of those factors are really going in our favor. We can't fight the clock, and we also, can't fight the eternal bullish wall that the S&P 500 seems to continue to climb. But the sharp move down is actually one of the most interesting scenarios that I think is to talk about in terms of rebalancing and understanding that really how the elevated implied volatility changes the risk reward structure of a trade. So I think, Ian, you were showing examples where we were talking about, 1 to 3, maybe 2 to 1 in the sort of max loss yield scenarios. As that volatility number goes up, those are going to look a lot closer to 1 to 1. So not only do you have the 1 to 1 ratio upside downside, but you get a wider max profit zone. So as implied volatility is going up, your max profit zone is going to widen because you're selling more expensive options. If we're familiar with the straddle trade, selling an option, both a call and a put, is a completely market movement type bet. That if the greater the price of those options because of higher volatility, the more the stock is going to need to move to make that payout. So in higher volatility, you get a wider max profit zone and you get more favorable risk reward on the upside yield compared to your downside risk. So sharp moves down, while they might mean locking in a loss early on in the trade, it does present a great opportunity to capture that implied volatility at its elevated level. So rebalancing can take a lot of different flavors. We can rebalance because the market's in our favor, because time has passed, or we can rebalance because we see greater opportunities and better risk reward propositions to expose ourselves to in the markets. So while these trade structures look like they go out over time, over that 1, 2, and 3 month period, we're constantly monitoring how they're evolving and looking for those opportunities, to take some of that money, lock it in, and move on and reset, for another favorable opportunity.
And, I think it's good to even go back to the very beginning. We discussed execution quality a handful of times, and for rebalancing, it matters also, right? When you're looking at systematic trading, the strategies for the model portfolios, when you're rebalancing, every penny counts. So good execution quality and approach, will really help, again, keep you in the game, especially in the sharp move down scenario. And the execution quality, again, all those pennies add up to dollars. It's really helpful for your reward to risk ratio.
That's a great point about the the volatility environment and how much execution quality really matters across volatility environments. Prices get very tight when things are smooth sailing, but when things kind of get a little spooky, prices widen out. People are less willing to commit capital. Dealers are less willing to put capital at risk. And so, it is a little bit trickier to navigate those scenarios. So that's why it really matters putting your orders in the right places, making sure you're posting, making sure you're accessing spread books. All of those different components really play into how you can drive execution quality and pick up those extra nickels that really add up over time. So I know Ian and I have actually talked a lot so far, and we got one great question from one of our participants here. But I wanted to open up the forum to see if there were any other questions that people had about the model portfolios, sort of what the difference is across the different trade structures, maybe how we think about aligning them, how we think about setting them up, what we look for over time in these scenarios. Anything's fair game at this point. So, to talk a little bit about the model portfolios, Ian, I think, mentioned that the main benchmarks that we use are the SPY, the QQQs, and the IWM. And so those are available starting at $1,000. So you can access this type of exposure with a very small account and put your money to work across any of these different structures. With larger account balances, we start to look at some of the single names. We start to look at the Teslas of the world and the Apples of the world. And so really, it's not necessarily just about these benchmarks, but it's about potentially accessing this across all stock names. This type of formula does apply itself to many different other potential equities also. So actually, let me look. We got a couple questions in here. So do all three model portfolios use the Modify? So yes, the Modify is the basis of all three of them. And really kind of the way they differ is sort of where we set them. And the Butterfly fundamentally is really a great strategy to modify and stretch across the appropriate risk reward scenarios, because it provides us two things. It provides us the defined risk reward. So we have that capped risk, and that's really fundamental. I know we've said it a number of times, but I can't emphasize enough how much a defined risk scenario really makes a difference in terms of allocating capital over time and in terms of staying in the game. The best way to have a successful investment career is to make it as long a career as possible. The time in the market matters more than anything else. So having a good risk budget keeps you in the market for as long as possible. And so that's one of the major components of the butterfly and also the modifly in terms of having that defined risk. And the other facet that we really like about it is the premium collection, that these are established for a credit and that they are a short volatility strategy. Because net being short volatility over time is a feature we want to expose ourselves to, that the returns are generated in the options markets through a premium collection strategy in a very defined risk manner. And how you want to allocate that, what's sort of appropriate for your risk tolerance, for your objectives, for your timeline, and your investment life cycle is each of those three flavors of diversify, amplify, and protect. So the other question that we got is how often should I expect to rebalance for a loss versus rebalance for a gain? So it's a really good question. And the rebalance, maybe I'll put some specific scenarios on this to give an idea. If we initiate an amplify fly and the market were to move up over 1% within a week, that happens about 30% of the time. If that happens, we're able to close out for somewhere between 50 to 70% of the value of that. So if we can close out for 50% to 70% of the original our profit target within a week, we like to take that. And so that happens about a quarter of the time. Step out another week, we tend to see opportunities to close from both the theta decay. So you've got 2 weeks under your belt and you potentially got market movement in your favor. We see an opportunity to close for similar 50 to 70% of potential profits within that 2-week range. Once you start to get out to the 3rd week and the 4th week, the 3rd week we find to be a relative scratch, and the 4th week tends to be the scenario where we're either waiting for that max pin, and so that would be that scenario where we're really hoping it's going to zone in on that max profit zone and we're holding out for it, or the market's moved against us and we haven't had the possibility to close it out over time because it has leaked down. So in terms of how often is it a loss versus a gain, more often we try to lock in the gains and reset probabilities moving forward. That the real scenarios where we're locking in a loss to rebalance for a loss would be that sharp move down where we see sort of an exogenous event that hits the market. That really, we want to look for a big volatility spike because of that. That if the market just drifts down and volatility isn't necessarily more expensive, that it's not necessarily interesting to rebalance for that loss, that we want to rebalance for those losses when our expected profit going forward is much more favorable. When we have that wider max profit zone from the elevated volatility, when we have that more favorable risk reward ratio from the upside gain to the max loss. So those tend to be the scenarios that we would be rebalancing for a loss. And they don't all look like the U.S. debt getting downgraded in 2012, or the COVID pandemic in March, or the flash crash. That it's not necessarily a slump of that magnitude, but to the extent that we did see a 3 to 4 to 5% move within a week or two, that's enough to really get some elevated volatility in the market and provide that favorable ratio going forward. So both really good questions there. I think the modify, the reason we like it is not just because of the cheesy pun, but because of its real flexibility here. And we're increasingly working on tools that will allow us to provide even more customized modify solutions, allowing clients to target exactly where they want to center that max profit zone and widen that to the degree that they're interested in, and modulate their risk return profiles to really fit exactly what they're looking for. And there are lots of different names out there that this is possible in, and lots of different theses on those names. So really the model portfolio approach and the modify approach is a very adaptive market approach across both names and market environments. So that actually looks like the two questions that we have for now, and it is 7 p.m. Central Time. So I know that everyone turns into a pumpkin after an hour, but we appreciate everyone tuning in this evening. I hope this has been educational. This will be going up on our YouTube. So feel free to tune back in and share it with all your friends. You can check us out on Twitter also. Our Twitter handle is @harvested_DAFE. And that's because derivatives are for everyone. And that's very much our belief here. We set up the model portfolio so that individuals, retail accounts can have access to the power that option strategies can provide. And no matter what your flavor is across the diversify, amplify, or protect range, model portfolios can provide a solution to deliver the returns in that alternative investment sleeve. So thank you so much for joining us. We're always available for questions. You can contact myself, you can contact Ian, just Ian@harvestedfinancial.com and Mark@harvestedfinancial.com. We'll be doing these again shortly. And thanks again. Enjoy your evenings, everyone.
Thanks a lot, everyone. Have a good night.